Well, hello everyone. This will be another podcast today, and we're very lucky to have John Ing with us from Maison Placement. We'll be talking about everything related to gold and its recent rise and where we see it going in the future. John, maybe do a little quick introduction on yourself so people know better who you are, and then jump into your slides.
Sure. Glad to be here, David. Always glad to talk about my favorite subject, gold. I've been following gold now for something like 5 decades. I've seen it gold at $35 an ounce, seen it at 3,500. And the obvious question everybody asks is how high? Um, we have been following gold. Financing companies, giving advice to governments. And I have found throughout my career that nobody, including myself, has the answers. But one thing I do tell people is gold is a store of value. It's not just a 50 years or 100 years, but it got a few thousand years of history as a store of value. So I've been described sometimes as a gold bug. I don't think that that's the case. I think it's just there is a role for gold, and this is what we're going to talk about today.
Excellent, John. Well, take it away. And just unless I misheard you, the top you've seen so far is 3,500, right? Is that the
That's
peak so
correct.
far? Yeah.
That's correct.
Okay,
We
well,
just hit.
on to
We
the
just hit that.
slides. Yeah.
Yeah. The first slide is a classic. It's Mr. Trump's signature and really what the markets have been doing. Surprisingly, when Mr. Trump's first term, the markets did well, and everybody had very optimistic views of him. And as we have found out, and you can go to the next slide, that it on how on his first term how he did so well, and the second term it's been miserable. And the classic question is there is I think one certainty, and that is Mr. Trump doesn't know what's next and the uncertainty of Mr. Trump. And that is why, bottom line, that gold is a pretty good hedge against whatever is going to happen. Next slide. So again, we have seen the Standard and Poor's had done so well. Gold, on the other hand, next slide, has really done the classic hedge. It's up 27% over last year, and that was up another 20%. Gold has tripled since 2015, and right now everyone thinks that this may well be the top. And is this a dangerous area to be in? And I don't know, but I look at the technical, what they call relative strength, and that is at a very high peak. So yes, we're in need of correction. We hit 3,500. Maybe we go down to 3,000, but my expectation is that 3,500 is not the peak. I can recall when gold was what I called $1,000 for gold, and when it happened, it took a few years. Then the next target was 2,000, and that took a few years. And what you learn about gold is that every peak is surpassed, and so my expectation is that will continue. Next slide. And this is one of the reasons: is the world is at war. We have the world at war. Partly, we have the wars in Ukraine and Gaza, as we know, but we also have an economic war now. And this is the real reason why gold has propelled, is that for a long time, we had the US dollar was the heart of the financial system. Next slide. And that is no longer the case. And the reason is tariffs. Tariffs, we know, is right across the board, and it's on everybody, but in particular China. And the Americans are picking a battle with the other superpower, and this never ends well when you have that. This chart shows how dependent the US is on China. Not only just iPhones, electronics, but really China buys little or less from the US than the US buys from China. And that's because of the makeup of the US. The US is, has one time, and a throwback to Mr. Trump's view is he would remember when everything was simple, when the Americans manufactured their car, bought their cars, American made cars, and spent it in America. But then America became a consumer society. And when they did that, they were able to buy products much cheaper from other countries. Now, to Mr. Trump, that's being ripped off. But in fact, when you buy an iPhone, you give $1 out, and that dollar is recirculated back until now into recycled into buying treasuries, buying other things such as Boeing's and that. So there's an imbalance here, and the tariff war is the first real sort of volley in this economic war that we are seeing. Next slide. And what of interest, and this is why China's been getting stronger and stronger, is that China really buys more from Japan, Germany, South Korea, and manufactures more than the U.S. all combined. And that's the point: is that it is not only become the workshop for things like toys, but cars, green technology now, solar panels. We have artificial intelligence. China now has G networks. We're just happy to have 5G networks, but China has 10Gs. And so the expectation is that China has done well. Rather than spend money on consumerism, they have spent money on technology, and they have been preparing for this trade war. In the first term, they frankly won because they stopped buying canola from the farmers. They stopped buying oil. In fact, in this second trade war, China's buying oil from Canada and stopped buying oil from the Americans. So this trade war is going to hurt all parties, but it's particularly going to hurt the USA. So this is my point: is the dominance of China, and my expectation is that that will continue. China will sit back and wait. They believe in the long game. And my expectation is that the U.S. will go hot and cold. The tariffs will be on and off. There'll be exemptions. My expectation is that the EU, India, Japan, Canada too, I hope, there will be a multilateral trade, as we saw before Trump's term. This multilateral trade will be what I call Pax Globe and the U.S. And so we find two blocks, and there'll be trade among everybody else and trade in the U.S. Next slide, please. So this is turning up, and why this is driving gold is because the U.S. dollar, during troubles, during COVID, during the 2008 crash, U.S. dollar was the safe haven, was the place to be. But ever since the tariffs, the so-called Liberation Day, or even talk of the tariffs, the US dollar has lost almost 10% of its value. So normally during uncertain times, you buy the US dollar. This time, and this is the big reason, that in fact, the US dollar, as we know, is the reserve currency in the world. And that was established in the Bretton Woods. And when Bretton Woods established the dollar, it was the heart of the financial system. It was the heart of the economic system. In the 70s, it got too strong. In the 80s, under Ronald Reagan in 1985, it was so strong that they got the 5 nations, including the United States, together, and they pushed the dollar down. And so the dollar, because, as we know, doesn't have a gold backing, has really been a floating exchange rate, but it is what trade is based on. But once the tariffs were announced, there is no certainty, and that certainty became an uncertainty. The problem is that this time, America's indebtedness, and I've been talking about this for decades, more than a couple decades, is getting worse. They now have $37 trillion of debt. They're the world's largest debtor in the world. And China, coincidentally, as the largest creditor in the world. But that debt is now at 120% of GDP, only behind, I think it's Italy, Greece, and that there's, and it's fast becoming the largest as a percentage of GDP. Why? Because there's still $5 trillion of tax cuts coming down the pike as Mr. Trump will plow that through. And then there's something like $9 trillion over the next 12 months of US debt that has to be rolled over. And when this US dollar is coming down, what's problematic for the Americans is that they have depended upon maybe a third of their debt on foreign dollars. And if the dollar is coming down, it really means less, and if you bring in tariffs, it's less dollars that are being recycled. So that's one of the reasons is the confidence in the dollar is going down. And that's problematic for the US because they depend on outsiders to finance their debt. Next slide. And so you ask, where are money? Where's the foreigners? Where are investors going to put their money? And that gold is a universal currency. It is expressed in US dollar. So countries have been buying gold as a proxy for a dollar and as a hedge against the dollar. You have to look at what the central banks are doing. The central banks for the last 3 years have purchased something like 20% of the world supply every year, and they have been sopping up gold. You have investors, particularly led by China. China has the largest physical market in the world through the Shanghai Gold Exchange. They have bought something like 300 tons of gold, but they don't produce enough. So they have been buying gold outside their markets. And in fact, they've been trying to buy some gold mines. Next slide, please. And this is my point of the Americans' debt, is that in a few years, they will have surpassed what was World War II. This spending is just, there just doesn't seem to be any thought to it. Now, Mr. Trump expects tariffs will raise revenues. Well, the trouble with revenues is Peter Navarro, his guru on tariffs, best estimate is that they'll get something like $600 billion. But we have found that, of course, if tariffs sink the U.S. economy, and we are finding out now with ships offshore are 50% less than they were before, that in fact the American economy might go into a recession or likely go into a recession, and we'll get something like stagflation. Stagflation is low growth, and high inflation. And where's the inflation? Well, we had inflation already, something like 3 times what the Fed was looking at. But if you put tariffs are a tax, and that's inflationary. And then you couple that with the lower US dollar, that is also inflationary because it makes, ironically, their imports much more expensive. So you get a double dose of 2 evils, and you have rising debt. Now, one of the problems with rising inflation is you're going to get rising interest rates. Thus, the fight between Mr. Trump and Mr. Powell, Fed chair of the Federal Reserve. Mr. Trump of course, wants lower interest rates. Every president does. But the Fed is independent as possible. It's going to look at rising inflation, and that means rising interest rates. That's problematic for U.S. debt because already with interest rates where they are spending $1 trillion on interest payments alone. Now, that's a lot of money. But when you think about, they spend $1 trillion on defense, just like debt. So in other words, the interest costs today are more than what they spend on defense spending. Now you can say, what's $1 trillion? $1 trillion is if you spent $1 million every day, you'll be exhausting that $1 trillion in 7.5 years. So that's just 1 trillion. So the numbers are staggering, and that is the Achilles heels of America. Next slide. And one of the reasons why is that the Federal Reserve is under pressure is this is what they call money supply. This is the monetary base. This is how the Feds, how the Americans finance themselves. And you can see it goes straight up. And I believe, and that inflation is really the sum of money. It's a product of money. If you print too much money, it's going to show up in inflation. It's a monetary phenomenon. It's been written about, documented about, and the reality is you're going to print money, you're going to get ultimately inflation. And of course, gold is a classic hedge against inflation, not only as a store of value, but because of what's happening with the US dollar. And then you have the inflationary impact, expected inflationary impact. That is all what is telling us what's happening with gold. Next slide. Now, this is the reason why it's problematic for the Americans. US Treasury market has doubled in size. It's somewhere over $20 trillion. And in fact, this is how the Americans have been financing their deficits, their lifestyle. It's sort of like the credit card of when the Saudis were selling their oil to the Americans, they had a surplus of dollars. So they bought treasuries. And treasuries are very liquid. Treasuries are abundant, and there are short treasuries or long treasuries. And it's a very effective mechanism. It is the heart of the financial system. The problem is that once Trump messed with the economic system and the financial system, that treasuries are in fact being sold back and putting pressure. The reason why 10 years went up to 4.5% was because of a treasury auction which did not do well. The Americans have to go auction just about every week, and those auctions, if people don't want dollars, they're going to boycott. And in fact, that is what's been happening. China no longer is a buyer, hasn't been a buyer. They, in fact, have been lowering their debt. U.S. treasuries, the Japanese are the biggest, but the Europeans have not been buying treasuries too. And that puts financing pressure on the Fed. And how are they going to finance it? And that's what worries, is that you can get not only stagflation, but there always is the possibility of hyperinflation, which is what we had, of course, in the 30s. In the 30s, we had a situation where we had the Weimar Republic hyperinflation, but also in the 50s, we had the Great Depression, and that came about the economic shock of wars and that. And so there's a lot of potential parallels, and that's what's scaring the market. Next slide, please. Now we have Mr. Trump, and this is back in, my expectation is that when he's backed in the corner, he has to look at how to finance it. And there is talk today that Mr. Trump, Mr. Musk want to visit the Fort Knox, which is where the Americans store their gold. They store their gold. Americans have something like 8,100 tons of gold. There's something like almost 5,000 tons held at Fort Knox. Where did that gold come from? Some of it came from the reparations when the Germans lost the war. A lot of that gold came from in the 1934 when Roosevelt made it literally illegal to a felony to hold gold. And so they seized gold from people in the 1934 Gold Reserve Act, and they confiscated the gold at $20.67. You got a piece of paper, redeemable, and it was later that they revalued it up to $35 an ounce. And actually, the government had an $800 million windfall gain on that revaluation. There is talk now of potentially revaluing the Americans' 8,100 tons. What would that net? There'd be something like $11 billion in potential pick up, and that could be put in the treasury. So there's talk of that. If there is any sort of revaluation of gold, then that would put literally a floor underneath the price of gold, which is another reason for the gold price moving. Next.
Sorry, John, if I could interrupt.
Sure.
So is the gold physically there in Fort Knox?
We don't know. The last time, it's a good question, David. The last time was 1974, I believe. There was an audit of the Fort Knox gold. So that's a long time ago. I've seen nothing in the last sort of few weeks on the audit of that. So it's a big question mark. At the same time, and it's very strange in the bullion markets, the Americans have been shipping a lot of gold from London, London warehouses. Gold is stored right around the world. And in fact, it's a big business, these warehouses. And to the point that there was talk that the reason why Americans were shifting gold from London to New York was because of afraid of tariffs. Well, gold doesn't have tariffs. My expectation is that there is concern of the not only the value of gold, but there's concern of some of the big banks, the derivative players, have been caught short. And for a long time, in the last 10 years, 20 years, it's been easy for the big bullion banks to sell gold from their books, derivatives, and just roll over. And what's happening in the last 9 months is that the physical market has been really tight, that in fact a lot of these derivatives now people are buying the near month and are asking for delivery. And so that's put a squeeze on the COMEX warehouses, and that's caused tightness in the market. The other physical buyer is the Chinese through the Shanghai Gold Exchange. If you look at their open interest and at there is constant buying of gold. You have the Indians, who are the largest actually buyers of jewelry and of hundreds of tons of jewelry, and they have been buying of late. So my expectation is that the physical tightness of the market is behind reason why there's a need for an audit. And if Trump does not visit Fort Knox and does not have 5,100 tons, then it's really problematic. Now, you will look at this chart, you'll find, yes, the Americans are the big ones, but the Chinese have come from nowhere, and they are now number 5. Russia has been selling some gold initially when they started the war, but lately they have been buying gold because you can receive pretty good prices for their oil. So my expectation is that every country has been buying gold, except for Canada, of course. We have no gold in our reserves. We sold it when Mulroney's Conservatives were in power. Next slide. This slide illustrates, actually, we talked about earlier, what the Chinese need. And spending time, because I think that the Chinese, what they consume, what they need is look for the next few years is problematic. There are some commodities that they are self-sufficient in, but there are a lot of commodities that they need. We know that they have a lock on critical minerals, and that's very important. But one of the things that they do not produce enough of is gold. And so I continue to think that that will be a very tight market ahead of us. Next slide. And that gets to the obvious question, is that since gold has been over $3,000 an ounce, the gold stocks must be our barn burners. Well, this is a very telling chart which shows that gold as a percentage of total global assets is still less than, well, I think it's more than 1% now, but it's still less than probably 5%, which you go back, whether the 1930s, 40s, I can recall on average gold would represent 10% in the 70s and 80s of global assets. But today, we not only do not have enough gold miners, but enough gold bullion. So that, I believe, is going to change. Next slide. And the problem for a fund manager or for investors is there's just so few gold miners today. We all know about Newmont, Barrick, and Agnico Eagle, but really you can fit the major producers around your boardroom table. There's maybe a dozen world producers, but that's all. And they're producing the bulk of the world's gold. And the problem is that even at these prices, it can take 10 years, 15 years, 20 years for a gold mine to get into production. And that's the shortage of gold, because peak gold arrived more than 2 years ago, and the gold miners have not been replacing their reserves. We have Newmont going through acquisitions, and they've stubbed their toe, not once, but twice, with Goldcorp and Newcrest. And they had to take some big write-downs, and they had to sell a lot of their higher cost mines. In fact, Newmont today's cost, all-in cost, is bordering $1,600 an ounce. Barrick is $1,500 an ounce. Agnico Eagle is a little less. Now, why that's important is that when the gold price was $2,000, they made very little dollars. Today, at $3,000, and Agnico Eagle, which is a Canadian producer, gets a Canadian price for the price of gold with US dollars. Agnico Eagle in the first quarter just announced a free cash flow of something like $750 million, up from $300 million. So they now, this year, are rolling in cash. And my expectation is that these gold producers will covet each other. And this is why the mergers and acquisition game has been so active. My belief is that a lot of the marginal mines have been bought up, but the big dollars are to be made are in the developers. Those are the producers that have already found their gold, now are financing or building their mines. Eldorado comes to mind, BT Gold comes to mind. BT Gold has the big Nunavut mine coming on stream. Eldorado has the big Greek mine coming on stream. McEwen mine has the big copper mine in Argentina coming on stream. That's where I would put my dollars. The Barracks of the world, Agnicos, they have done well. They will make a lot of money, but the big money is to be made in the developers. Next slide. And this is what my point is, that it takes such a long time to bring gold into production. And the problem is that it's red tape. Financing is less of a problem, but you have to go for red tape. You have to do not only 43-101 reserve calculations, you need preliminary economic assessments, you need feasibility studies, bankable feasibility studies. Then you can go to the market or to the banks to get the financing. Then you build it. And it could take 2-3 years. Kinross has this great bear in Ontario, and they haven't even got a pre-feasibility study yet. And yet they spent a couple $2 billion plus in buying that, and they're going to spend that just to get into production. Mining is a very expensive proposition. And that's the problem with recently Barrick sold its interest in NovaGold. That's in literally the middle of Canada's north. The problem with that is going to take $7 billion to put in production. So the money is big now to bring these gold mines into production, and that's problematic for these producers. I think that's it. The next slide, if there is a next slide.
Nope.
No,
That's great, John. That last slide is actually, I've never seen that before. It's quite telling that, that $8 peak for this developing miner, and then you might get $10 later on for it,
Yeah. I should put that, bring that more up to date, David, because I have calculated the developers, on average, a group of developers that I follow are trading around $500 for reserves in the ground. Today, on average, I think it's about 11 for the producers. It's about $11,000 for reserves in the ground. So there's a big gap there, and
Hmm.
thus there's really an incentive to go out and explore for gold. The problem is that you not only do you have that red tape and that lag, but all the sort of the gold miners have been plucked the easy stuff, and thus Barrick is going to Pakistan, and you go to parts of Africa looking for gold, and that's the difficulty is that there's a geographic jurisdiction that you have to be careful.
Yeah, really. What other businesses are there where you can get like almost 100% margin, gross margin from your cost of production to sale price? Like it's just an incredible business on its own, forgetting about what the commodity even does. So, yeah, I don't know why more people aren't lined up. As I talked to, but while we were getting organized for this call, there's a great article in Barron's this past weekend, and when you build it all in there, the average portfolio in according to how much is outstanding in the world and compared to the overall stock market is only a 3.5% allocation. Talk about how Americans have little to no exposure to gold and what sort of allocation you'd suggest for your clients.
Well, I've always felt that gold and gold stocks should be looked upon as fire insurance. You don't expect your house to go on fire to collect your insurance. But when you design a portfolio, you don't expect a disaster to make money, but you need a hedge. So I've always advocated a 10% between gold and gold stocks. But over the say 20 years, I've been following, or more than that, but in the last 20 years, as far as gold shares, there have been fewer and fewer investors. There used to be a whole bunch of gold funds, but now a lot of the managers have retired, the funds closed down, and these gold funds in the past they finance a lot of these junior gold miners. Today that's not the case. You have ETFs, exchange trade, the big ones that are traded, but they invest in the big caps, in the middle caps, and mid-size. They do not invest in the juniors. And the lifeblood of really of this industry, to me, is you have to find more reserves in the ground. You have to replace them, and that's not happening. My belief is you have to have some bullion, and you have to have a mix of the senior producers, a lot of the developers. To me, it's still early for the junior exploration ones, the ones that are drill hole specs, so to speak, the ones who have not yet have a 40 through one or have plans to our theories to look for gold. There are so many wannabe gold producers. I tend to spend my time on those with the exploration that already found the gold and are now just boosting those reserves.
Okay. You talked briefly about central banks, and they've been large net purchasers over the last few years. It looks on this chart here in this Barron's article, it looks like it's come off a bit over the last couple of years. But why are central banks buying? What could that mean? And will they continue to be buying?
I expect that they will continue to be buyers, particularly after the tariffs. Gold is expressed in US dollars. So a lot of them had US dollars, and now they're, particularly with the decline of the dollar, that's woken up some of the producers. A lot of the mid-sized countries, particularly the ones you find Poland, for example, after the Russian invasion of Ukraine, some of those countries around there. The world has become much more hostile, much more polarized. So central banks who have excess dollars will continue to buy. China, in particular, has been buying both officially. They stopped for about a 6 month period. About 3 months ago, they started again. And China buys in the open market, and they also buy through Switzerland. And Swiss exports have been huge, telling me that China is scrambling. It's believed, there is some evidence out there that they have double what they show on official reserves. Those numbers come from the World Gold Council, and they are the official statistics. But my belief is that there are continue to be what they call whale-sized purchases. So in this volatile world, if you were a central banker, to be sure, would you rather hold the US dollars, which you're stuck with, or gold? And I think that's what we're seeing.
Okay. Yeah, it's a great market. Silver. What are your thoughts on silver? It's been lagging the price movement of gold. Is that going to continue, or where does silver stand in the whole spectrum?
Yeah, that's a great question. It's a common question. Silver is not a precious metal. It's a byproduct of industrial production. When you produce zinc, you often get silver. There are very few pure silver producers. And that's one of the problems. The point is that silver's not held in reserves. At one time, there was China, in fact, the U.S. itself during the Civil War was on a silver standard. China was on a silver standard, and from time to time, we've seen in history that's the case. But while today companies are not on a gold standard, what's held in reserves are important because that's what that's their asset. So we don't see much silver, and so I see silver doing well. It's a commodity, it's an asset, but it will not do as well as gold, unfortunately.
David, I think you're on mute.
Yeah, David, you're
Yeah,
on
thanks.
mute.
Sorry about that. Question that came up. Do you foresee inflation surging once again due to tariffs?
There is a very real possibility of stagflation. If I had to guess, that's probably the best case after this tariff debacle. I worry about if the US economy really sinks because of these tariffs. We've already had a dramatic drop off in consumer sentiment. If we get a COVID type of stoppage in the US economy, and at the same time we get running inflation because food, for example, basic things like pop cans get out of whack, you could have a double dose and you could get this stagflation. Next stage is hyperinflation. And the policy response, if Mr. Trump annexes and decides, okay, the hell with the market, let's bring down, and we use my executive powers, bring down interest rates. What we have is what they tried in Turkey, and that did not work. In fact, it compounded itself. Zimbabwe, Venezuela today. If you purposely bring down interest rates, print money, money loses its value. And that's the risk that's out there. And what a probability. You can use AI today and say, okay, these are the equations. What are the probability? Well, 6 months ago, 9 months ago, we would have been zero. But to be sure, it's more than zero today. So I worry about that. I worry about the state of the stock market. The stock market today, you take Tesla, which has been beaten up in the market, it's still trading at 200 times earnings in comparison to maybe 6 times for General Motors. I mean, it's the market out there is still very crazy as far as valuations.
Yeah, that's for sure. Nothing's really changed that way. It's slipped a few percentage points, but nothing meaningful on the valuations. Okay, well then maybe just wrapping up here, and thanks a lot for the time today. Where do you see the price of gold going?
Well, I can recall, David, in 1971, when gold went from $35 to $850. That was January 1980. And everybody said that was the highest that we'll ever see. Well, that was 2,300% move. Then in 2011, when gold went, with the low was 252 to 1,900, everybody said, oh, that's it. That was a 653% move. So today, gold's gone from 1,900 to 3,500. They're only sort of 85% or 90% above the peak. This could be a lot more based on historic, on this bull move. And so I don't know how high it's going to go. My last piece I wrote, I thought 3,300. We got that easily. I see some stuff, I measured moves, probably between 4,500 and 5,000. I honestly don't know. I can look at it in technical terms. I think that, as I mentioned, gold is overbought right now, has to pull back, should pull back or go sideways. It's a good time to buy because the next move will be something quite dramatic. And the other point is that there's only 400 mines in the world today. 21 of these mines produce over 500,000 ounces, 500,000 ounces. There's only about a handful, 6, 7 mines that produce over 1 million ounces. And the world consumes a lot every day. And so there's not enough gold being found. There's just more demand than supply. So my expectation, and then we have the Trump factor. And I honestly don't know what the only certainty about Mr. Trump is the uncertainty it brings.
Yeah. Well, let's leave it there. So thanks a lot for these words of wisdoms, great slides, and yeah, I think we'll wrap up. So everybody who's listening in till the end here, thank you for your interest levels, and as always, reach out to us if you'd like to learn more about what we do or how John Ing's work integrates with ours and how we come up with a portfolio of currently greater than 10% in an allocation to stocks or to physical gold, silver, and platinum, and also precious mining miners.